the U.S. is now responding to China in multiple ways, both economically and militarily. We're going to see a lot more deglobalization and reshoring of supply chains, duplication of supply chains, and we're going to see a lot of like what economists call supply shocks. I think the two things that he's kind of seeing going forward is like we're going to have higher inflation, partly because of government spending, but partly because of these supply chains not being quite as efficient.
1, 2, 3, 4.
Hey there. Welcome to The New Rules with Alan Pentz, where we help you navigate today's chaos with precision. Your host, Alan Pentz, has 25 years of experience working in business and government, and he knows how the old rules have fallen apart. Each episode, we'll explore how to thrive in this new landscape by mastering the new rules while everyone else is still figuring them out. Let's dive in.
All right, this week on the pod, we're doing something a little different. I've been writing a lot about what I call the new rules, so kind of getting away from just small business and talking more about what's happening across the world. And then, trying to think about the longer term trends rather than like sort of the day-to-day stuff. So this week, I'm going to do a new format, and I brought in an awesome co-host, Tonya Berenson, calling in from San Cugat, Spain. Is that right, Tonya? You're back?
That is right. Just outside. It's a suburb of Barcelona, Alan. Let's say that.
Yeah. But Tonya is a townie from Maine, so don't let her fancy new residence fool you at all. She's a small town girl at heart. So, all right, Tonya, so kick us off. What are we talking about today?
So we're going to talk about trade war in China. You said forget about Taiwan.
All right.
Right.
The real war is a trade war.
So you started out by saying a lot has changed in 5 years, and you had a Wall Street Journal article that you included.
Yeah.
So what's changed? Let's start with that.
Yeah. So what I was surprised at is we kind of lived under this regime where free trade was like sacrosanct. And to see an article in the neoliberal leading paper, the Wall Street Journal, saying that there were problems with free trade was pretty amazing to me. And I don't think that would have happened even 3 years ago, much less 5 years ago. So really the main point I had was, I think in the US, we obsess a lot about Taiwan and the idea that China might invade Taiwan, which, certainly is a possibility. I wouldn't deny that. I think it's probably a remote possibility right now. But really as we're obsessing about that, we're missing, not totally, but we're kind of missing the subtext here, which is that the Chinese economic model has become what I called it like a dagger pointed at the heart of world manufacturing. So I think what we've seen over the last few years is that China had a model coming in, a very export-driven model where they would kind of take savings from normal people, so everyday workers, kind of keep your wages low, and they would take that money and subsidize export-driven sectors. So, a lot of manufacturing. And that's sort of a model that everybody did. We did it in the United States until the Great Depression. Japan did it, South Korea did it, Germany, all these countries have done that. And at some point, that model breaks down. And that has not happened in China yet. And the problem is that, South Korea does that kind of model. It can cause distortions in the world market, but South Korea is only a limited economy, right? China has become a massive economy. And for them to continue to suppress the wages of their workers to support global exports has become what I call the dagger pointed at the heart of the world economy and world manufacturing, because as they subsidize these sectors, they wipe out any ability of companies and other countries to participate in these sectors because our countries don't subsidize them at the same rate. So I think it's a huge issue that's caused, to be honest, I think this really started in the United States in the late 60s, early 70s, with Japan and some of the other European economies subsidizing their export sector, started hitting Detroit, small manufacturing across the United States. That's about when you see the beginning of the decay of the American manufacturing sector. I think it was sort of tolerable until Japan got really big in the 80s, and we forced an adjustment on Japan, which led to the creation and popping of their asset bubble that they're only now recovering from.
How did we do that, though? How did we force the case?
Yeah, so we actually hauled them into the Plaza Hotel in New York. and the currencies were imbalanced, right? So you can go into a long discussion about how manipulating your currency allows you, if you keep your currency artificially weak, that makes your exports more attractive. So they forced a devaluation of the dollar against those other currencies, particularly the yen. So that forced appreciation of the yen that led to like the massive property and asset bubble we saw in Japan in the late 80s. I don't know if people remember, but they said like one block of Tokyo is worth more than all the real estate in New York or something, some crazy stat like that. And then that blew up on them, right?
Yeah, that's...
So we were able to force that because, Japan was an ally and was under the U.S. defense umbrella. And so we could force them to do that. We cannot force an appreciation of the yuan.
Yeah, we can't do the same thing with China, to say the least.
Right. So, and if you look at what's happened, the yuan is 7 something yuan to the dollar. And China's economy and exports have grown, exponentially since 2000.
Right.
And that exchange rate hasn't really changed. I mean, it's fluctuated a bit, but really the yuan should be much stronger against the dollar. And they've been able to, essentially what they do is they sell stuff to us. We buy it with dollars. They take the dollars and they recycle them back to the United States and buy U.S. financial assets mostly. So that would be treasuries, mortgage-backed securities. And so that, Wall Street loves that, right? So Wall Street gets a nice vig off of all that recycled money. And that then balances the currencies, right? Because China's able to prop up the value of the dollar by buying dollar assets. So this has kept their manufacturing sector more artificially competitive. And in addition, they're not only doing that recycling of the dollars we send back to our financial markets, they're also subsidizing their industries at an incredible rate. I think the estimate is somewhere, between 2 and 5% of GDP, Chinese GDP it goes into, subsidized loans, direct subsidies into the manufacturing sector, which is about 5 to 10 times more than any other country in the world.
So this isn't really following a free trade model then.
Right.
Because you talk about, in a normal free trade, in a quote unquote, theoretically, a free trade model would do X, Y, and Z, right?
Right.
Wages would rise, prices would come down, and then Chinese consumers.
Right. In a normal world, you'd have, so China would be cheap because it was poor and they have all this labor, right? And then they would hurt U.S. manufacturing, low-end manufacturing, because they would be more competitive. Well, then as we sold them stuff, their currency would appreciate and their exports would eventually kind of even out and they wouldn't be as competitive. And then those workers would get a share of the gain of their exports, right? Through increasing wages. And then they would use that money to buy imports. And that over time, you should act like, in the words of Michael Pettis, he's a scholar that studies this, it's kind of a Keynesian view, is like, the purpose of exporting stuff is to import other stuff.
Right.
So you use your exports to get currency to buy imports. And that's the way a real free trade system works. It might not be, the US-China thing might not balance, but it should balance across the world.
Right.
And so the problem is what you have with these, they call it a beggar thy neighbor strategy, is where you subsidize your sectors or artificially repress the wages of your workers. You never allow that adjustment to happen and you just keep exporting. And the problem is it works temporarily for the export sector in your country, but it actually makes everybody poorer over the long term. So what China's doing is gutting these manufacturing sectors in any country that allows that free flow of, in particular, capital back in to prop up their markets. And you can look at the countries that do that. It's mostly the United States, Britain, Canada, Australia, maybe a couple others. And as a result, you look at the manufacturing share of those countries, like how much of their economy is manufacturing, and they're way below the global average. And China's way above the global average. So as a result, I link what's happening in, the UK anti-immigration riots are 100%, I think, the result of gutting the manufacturing sector, which is mostly the Midlands and Northern England,
right,
in favor of the financial sector in London that makes a vig off of all those recycled dollars and pounds coming back to the economies.
Yeah, and you had said you think, Trump's popularity has something to do with that as well here in the U.S., so all of these things.
100%. Yeah, I think it's all about Main Street versus Wall Street, and Main Street is angry
Yeah.
And for good reason, I believe. And I think Trump was an effort, the tariff policy. I mean, just look, when Trump came in, people thought, tariffs, what are you talking about? That's like something from 1600s, right? It's like, oh my God.
Tariffs.
And then we did it. First of all, it was fine. Second of all, it was, it actually produced some good. So, I mean, I don't think that's like, I think probably to understand what we should do, it's a much more complicated conversation. Tariffs are part of it. The problem with tariffs is they're pretty blunt instruments. They punish. If you just put tariffs on China, then they move all their goods to other countries that don't have tariffs, right? To Mexico, to Vietnam, So you kind of, to make it right, you got to put tariffs kind of everywhere. And then once you do that, you're punishing the countries that engage in these beggar thy neighbor policies, as well as the ones that don't.
Exactly.
So tariffs can really make everything less efficient. I think the other thing that we're looking at doing, which again, I think we need to do, is we subsidize our own sectors, or our own strategic sectors. And we just did that with the CHIPS Act for semiconductors here in the United States. We did it to some extent with the IRA and bill legislation, for things like solar panels. And that's good too, because you're subsidizing your industries to offset the Chinese subsidy. But in reality, in the end, that just makes everybody make more stuff. And so there's more global overproduction when everybody's subsidizing, right? So I pay you to make EVs in America, and China pays their people. And now we have so many EVs, they're like, we're up to our eyeballs in EVs that nobody wants, right?
Yeah.
So that doesn't make everybody richer, but that makes everybody poorer in the long run. But it is a response that's legitimate, I believe, legitimate response in key sectors.
You mentioned there was a Massachusetts company that made, what was it called? Cubic something. I mean, this was a while, silicone wafers. And what did happen with that?
Yeah, they just got wiped out. Yeah, you're seeing that everywhere, right? And what really happens in the end when the Chinese subsidize these sectors is no one wants to invest in them.
Right.
And even the threat of a Chinese subsidy is like, well, forget it. Like, we're not. So you look at like the batteries, the batteries are really big, for green energy, and the solar sector, cars now, especially EVs. I mean, semiconductors are another one. And, China's targeted these strategic industries. And unless the U.S. is willing to subsidize, which we have in a couple of cases, or employ pretty steep tariffs, I mean, you're talking like no private sector entity is going to subsidize that, because it's just not worth it.
How does regulation play into this? I mean, you sort of talk around it, but what can you say about regulation in the Chinese market?
Yeah, I mean, that's a part of what we're talking about too, in the sense of like, that's part of the subsidy.
Right.
You can view that in a bunch of different ways. I'm going to put another earpiece here.
Yeah, I think it would be helpful for some listeners to talk about that.
Yeah. So I guess what I'd say is regulation, you go here to the United States or Europe to get projects off the ground. If you want to go build a solar farm, or you want to go build a nuclear power plant, or pretty much anything, you're going through years of environmental reviews and, tons of cost and litigation and community involvement and all that kind of stuff. In China, they just plow right over stuff, right? So I'm not saying that's good, but we do have to recognize the differential in regulation. It's a huge reason a lot of our companies, like when we did all this green regulation back starting, actually the National Environmental Policy Act, I believe it's called NEPA, passed in 71, sort of went into effect about 71, 72. You saw just this massive movement from that time forward on, like we haven't built a gas refining facility, a petroleum refining facility in this country for 30, 40 years. Same, nuclear, we just built one the other year in like 30 years. And the reason is these kind of regulations. And then what companies did is they just moved all that crap to China, right? So they were like, hey, I can arbitrage this and go to China and get, a much looser regulatory policy and import back. So, I mean, that's definitely a key factor. And it's not that I think we need to equalize regulation. I think that's probably unachievable. But I do think we need to calm down the excesses of US and European regulation where, you can bury a project for 7 to 10 years. I mean, the average NEPA review now is like 5 to 7 years. It's ridiculous. So I do think we can get to a point where we reform the review process, get it down to 1 or 2 years or something like that. And I think that'll help us, improve the competitiveness of so we can build crap again in our countries And actually, Mario Draghi, we were talking before taping, he just did a big report on the EU, which I'll talk about next week. And that was a huge problem he identified as well. It's just, you can't build anything.
Yeah, I can't wait to read that. Well, I mean, so earlier you started talking about Dario Perkins, because I think your listeners know that you also have a shorter newsletter that comes out on Wednesdays. And you talk about different things that you're reading that's interesting. One of the things you also put in there was China and AI. I know that's China, but it's totally different, like AI. We can talk about AI.
Listen to a great podcast with macro analysts on a podcast called The Market Huddle.
Okay.
Dario Perkins. And he kind of perfectly encapsulated sort of my view. Like we just talked about China and some of the things that are happening in geopolitics. And, this is sort of the investing side of how's that going to play out for investors and, from your 401k to hedge funds and everybody. So I think, he had a pretty good view on the economy that I totally agree with. And so his take is, look, we're moving into, because the US is now responding to China in multiple ways, both economically and militarily, we're going to see a lot more deglobalization and, reshoring of supply chains, duplication of supply chains. And we're going to see a lot of like what what economists call supply shocks. So that's like what we had during the pandemic where, something happens, China shuts down, or, maybe there's a war in the Middle East and oil shuts down, or, Taiwan, something happens in Taiwan and chips go dark for a while. So those are supply shocks that can have huge ramifications on the economy. So I think the two things that he's kind of seeing going forward is like, we're going to have higher inflation, partly because of government spending, but partly because of these supply chains not being quite as efficient. And it's going to be, higher inflation is more variable as well. It'll go up and down more. Now, it won't be like, I don't think he or I would say that it's going to be crazy inflation. It's not going to be what we saw, 8-9% right after the pandemic or at the end of the pandemic. But I do think it's just going to go up and down more. Like we've had 40 years where it just went down basically every year. And down to almost zero. Well, in Europe, it was zero, but here it was just above. And we're just not going back to that.
But it's definitely there.
We're going to be in this elevated, maybe 3-4% inflation, and it'll kind of go all over the place. So, and it'll go up and down all the time.
Yeah.
And so that's not really a bad thing. Because to be honest, like the really low inflation was during the 2010s, and that was sort of deflation, where things were getting cheaper too quickly. And as a result, we had pretty crappy growth. I think we'll have higher and more variable inflation, at least in the United States. I think we're seeing it now. We're having higher average GDP growth every year. And I think it's helping with wages. So I think in general, it's going to be pretty good for the workers and for regular people.
This is so interesting, Alan. Say inflation is going to be good for the... No, it makes sense when you explain it.
So moderate.
Yes.
Moderate inflation. Like spiking high inflation that's going up, that's not good, right? Because wages can't keep up with that. But a moderate amount of inflation, especially when there's productivity growth, which I think there will be because of AI. And as we reshore stuff, we'll be working on that. So I think it'll in general be good. But what's going to happen as a result is like we're used to these downturns that are caused by credit problems. So like, the great financial crisis was a big credit boom and bust, right?
Right.
But if you look at household indebtedness in the United States, it's really low. I mean, our government might be indebted, but people really aren't. And so what you're going to get is downturns driven by supply shocks more than credit cycles. So it's going to be more like the 70s. And then there was an oil embargo, and we had this huge, massive supply shock, right? That's more what we're looking at in going forward. So pretty good environment for wages. Supply shocks are not great, but they're temporary, hopefully. And I think we're going to have better productivity and wage growth. And so what you're going to see is it's shifting the world from everyone always pays so much attention to the Fed and whether they're going to cut interest rates. And so that's all like monetary policy, right? Big government monetary policy. That's sort of like in a deflationary environment. That's what really matters.
Yes.
And we've been trained since like Alan Greenspan to care like what the Fed does every day. But really going forward, it's more going to be fiscal, which means what the government spends. So you think about monetary is like the central banks, the boring technocrats like Mario Draghi. And fiscal is like, stuff that government spends. So like the IRA bill and that kind of thing, and CHIPS Act. So I think going forward, fiscal is going to be that government stuff's going to be a lot more important to the economy. And that's going to put, Congress and the administration at the center point of the financial system, not the Fed.
Yeah.
And so I think what you're going to see, as I talk about investing a lot, for the last 40 years, the portfolio to own has been 60% stocks and usually US stocks and 40% treasury bonds. It's called the 60-40 portfolio. And it's sort of like the standard, like if you're in a target date fund at Vanguard or Fidelity or something, most likely you're somewhere around that 60-40. Maybe if you're really young, you're 80-20. And then as you get toward retirement, you might get down to 40-60 the other way. So that portfolio has been the one to have. And it works really well during deflationary times when the 40 in the treasury bonds goes up as interest rates go down, right? So like treasury bond becomes more valuable when rates go down.
Yeah, let's go back to the 60-40. So you're talking about in inflationary times, the 60-40 has always worked, right?
Yeah, so it worked really well to have the 60-40 portfolio because the 40% of treasuries would go up in value when the stocks went down, right? And they were uncorrelated or reverse correlated. And what we're going to see now is as inflation goes up or is more variable, that's really bad for treasury bonds because like you buy a treasury bond at 4% for, 5 to 10 years. And then, a month later, interest rates go up to 5%. Now your bond's paying 4 and the new bond pays 5. So like you want the 5, you don't want the 4, right?
Right.
So in a time when inflation's going up and down, that's really bad for treasuries. And then what happens is when inflation's rising, we saw this in 22, is inflation and stocks become correlated during inflation because both kind of go down immediately, right? So that's not a great portfolio to hold anymore. I still think it's been great for 40 years and everyone loves it. And there's so much money in the United States in these funds that I think it's a huge issue going forward. And what we're going to need to do is really think through how to diversify portfolios going forward. So we've got, the treasury bonds, I wouldn't say get rid of them altogether, but I think what we're going to have to do is bring in new assets that haven't really performed for the last 40 years because of lower inflation. And those assets are going to be things like real assets, like commodities. And people, those are hard to own. They go up and down a lot, but they're the kind of things that are going to be diversifiers during those times of higher and more variable inflation. So I think what we're going to have to do is adjust the 40 and that 60-40 to be like, some treasury bonds, because there will be times when inflation goes down. Again, I said it's variable. It's not just higher. So sometimes it'll go down and sometimes those treasuries will act as a diversifier to the stocks. But in times of rising inflation, you need those commodities and assets like that, real assets. So I think we're going to have to mix those into our portfolios. And then I think on the 60 side, as I said earlier, most US investors have been almost exclusively in US large cap stocks, to be honest, like mostly S&P 500 and then, NASDAQ kind of stuff or like Magnificent Seven, the big tech companies. And I just don't see it's not that you get rid of all of that, but the chances that what worked for the last 15 years is going to work for the next 15 is pretty low. And I think people are going to really need to look at what economies perform better during inflationary times and what economies are cheaper now. So if you go to Europe or Japan's had a little run here, but if you look at how much you're paying for the earnings of those companies, it's much lower PE than the United States. And then if you look at, like an emerging economy, first, they're cheap. Second of all, they respond very well to inflation because they already have inflation. So they have the kind of economy and a lot of them are commodity based economies, right? They're exporters of commodities. So they tend to do well during inflation.
Right.
So I think what we're going to have to do is take a look at our portfolios and start diversifying them. It doesn't mean you get rid of all your US stocks and go all Europe and EU.
Do you think this will freak people out when you say we're just going to have to start changing our whole our whole sense of portfolios and how we invest? I mean, it makes sense, but that's no small feat.
Right. And I think it's going to take a prolonged period of underperformance.
Yeah.
So, look, I run a company and, you get default investment options and you don't want to get sued for.
You mean like through your employer provided?
Yeah, like I got a 401k. I put in options for people to invest in, at the company.
Right.
And there's been rulings by, I don't know, it's labor or whoever regulates that under ERISA in the United States. And like they said, you can get sued if you have crappy 401k options, right?
Yeah.
So they said, oh, well, target date funds, those are okay. You can do this. Like go get Vanguard or BlackRock or whatever, target date iShares or whatever. So we put those in there and everyone's invested in them.
Right.
They just keep putting in dollars.
Yeah, no, of course, because it's safe.
Yeah, I mean, its default options are pretty powerful. So I think it's going to keep going like this for a while.
Yeah.
And we're going to have a couple more periods, like maybe not, it's not going to be as bad as a pandemic, but we're going to have a significant period of underperformance for those portfolios a couple times. And that's when people are going to change. But it's going to take a while. So I think people are going to, looking forward to like not so great returns for the next decade until they adjust.
So we have to brace ourselves.
That's right. And then they'll adjust. And then if you get in early, you'll make a ton of money. So I'm giving you I'm not an investment advisor, to be clear. So you should go talk to someone.
You just play one on TV.
That's right. I just play one on the radio. But, I do think that, and again, I'm not telling people to go from 60% US stocks to 10, like maybe put in 20, take 10% into emerging or 5 or 10% into emerging, a little bit into Europe, right? Just diversify that portfolio. And like maybe you don't, commodities are tough to own. They are cyclical and they go way down, they go way up. So there are ways to own them there are a lot more products now that are freely available and lower fee, open to like managed future is a product that I invest in. And it's probably too much to get into on this podcast, but I do think that those are options that we're going to have to, and I'll probably write about this in the future, like what I think the new 60-40 looks like, probably in more depth and get into that a little more. But I do think it's something people have to start thinking about because for a long-term retirement, if you're mostly invested in US stocks and treasury bills, I definitely don't think you're going to get the returns that you got over the last 40 years going forward. So you got to plan for that.
Which could be really scary for somebody, of course, much older than us.
Yeah,
but
exactly.
Or not really.
Right. I mean, even for us, like if you're in your 40s or 50s and you got a lot of money in there,
yeah,
you might not have, if you keep going this way and like we have some serious bouts of underperformance, you might not have enough time to recover. And, I think it's a real issue and I think we should be talking about it more. And like, this is one of the reasons I started the newsletter. It's like the rules have changed, right? We had 40 years, really, even before the end of the Cold War, but on the investing climate. But since the end of the Cold War, we had 30 plus years where things were different. I mean, it was a US dominated unipolar world with, increasing amounts of globalization and free trade. We had China come online with, 100 millions of workers and became an export powerhouse. The US, had this sort of shift from, getting a bunch of cheap goods and then shifting into service sectors and into the internet and things like that. And it like really helped a lot of people, but it particularly helped people on the coasts and not so much the interior. And so there was a lot of wealth and complacency generated through that. And now we're paying the bills, right? And that's going forward. We have the next 30, 40 years are going to be a lot different than that.
Right.
And that's sort of the point of the newsletter, kind of identify what are those trends. And this is one of them, and I need to write more about it and talk to some more people too, to really fully. So again, I'm not an investment advisor. Don't run out and change your allocations just because of what I say. But we are going to be bringing a lot more of that kind of content to help people think through it.
Yeah, to get people thinking about it, even putting it on their radar. I mean, sure, there's a lot of folks, in your circle who might know that, but your average Joe isn't thinking about this necessarily. So, I think it's a good way forward.
Exactly.
What else did you write about? You wrote about, again, we've talked about China and AI. And then you were talking, what I thought was really interesting is you highlighted an article in the Discourse. Is that what it was called?
Yeah, I think that's a magazine from George Mason's Mercatus Center here outside of DC.
So I really enjoyed reading that. I thought it was interesting and how it ties into what you're saying, like the government's going to be more important in a way in what you were talking about financially. Yet that article is like, the new government is like not governing at all. Right?
Yeah, exactly.
More interested in communication and social media.
Yeah, so there's a bunch of stuff here. So this goes into like some work about, and this was written by Robert Trasinski, I think. Might not be pronouncing that right.
Sounds right.
And basically, this kind of gets into some stuff that the former kind of the architect of the Leave campaign in Britain and the former chief advisor for Boris Johnson, Dominic Cummings, who I think is probably one of the best people on politics out there, if you can read. I mean, if you're really into it and want to understand what's happening, now he's got a British view, but it's pretty similar. And one of his kind of sayings is that the government, and to be honest, I would say the politicians aren't really interested in running the government.
What?
And it's not something I didn't know, but when I read him on that, I was like, oh my God, you're 100% right. Like, basically what they're concerned about is the day-to-day news cycle and being famous.
Yeah.
And, you know, so I'd say, like, if you're on the Democratic side here in the United States, you're really focused on the progressive community of, you know, the voters, but also other politicians, the think tanks, the media organizations, all of that around you. And you're really concerned more about your standing in that world than you really care about, you know, what's legislation is happening in Congress. That's a secondary thing.
Yeah.
And I think on the Republican side, there's probably not so much of an elite that kind of goes across all these fields, because I think Trump really just destroyed that, has shattered it. But you're certainly more concerned about the press you're getting,
yeah,
and the headlines, and my ability to fundraise and do things separate from the party. And maybe my congressional career is just really an audition for my Fox News or whatever, you know, now it can be a show on X or whatever it is, right? So, you know, being in Congress is just kind of like a way to get famous or build an audience so you can go do something
right
later. And I think it was in the article I was highlighting, they were talking about Madison Cawthorn and kind of said, like, his take was, I didn't go in, when I went to Congress, I just hired a bunch of comm staff.
Right.
I didn't get a bunch of legislative staff. Who cares about that? That's boring. That's stupid. I got all people that know how to, like, get me in the media and, like, you know, so you're hiring people for their meme ability, not for their, like, ability to look.
And he's honest about it.
Yeah. Yeah. And I think it's totally true.
That's the thing too. It's like, it's true and he's open.
And to me, it's completely logical, right? Like, being a, you know, out of power or, like, you know, junior congressman from XYZ is like a pretty miserable experience. You don't have any power. You can't do anything. So, man, if you can say crazy stuff and get in the media, do it, right?
Why not?
And I think what the article was really then tying that into is the Supreme Court recently struck down this principle called the Chevron deference doctrine, right?
Chevron.
And long story short, basically a while ago in a case against Chevron Oil Company, the Supreme Court basically said, hey, look, we think that regulatory agencies in the federal government are experts in their field. And unless there's something really egregious, we should just, like, kind of defer to their interpretation of regulations and or of law and regulation. So it allowed a lot of legislation, even if it didn't cover subjects, the agencies could, like, regulate things that weren't really in the law. And the courts, based on this ruling, would kind of say, all right, well, you have a wide latitude because you're the experts. Now, the Supreme Court just overturned that. And so they're basically saying, if it ain't in the law, like, you can't do it. And this has created, like, a big kerfuffle, right? Because there's so much stuff out there that we currently do that's almost like a law that really was never passed as a law.
Yeah.
And Congress writes terrible laws. I mean, I've been there. It is.
You have been there.
It is a shit show.
You know.
Right. And they're doing this stuff late at night, last minute, running it over to ledge council, and, like, everybody's overworked and, like, it's all last minute, and they're, you know,
exhausted.
They're coming out. If you see some of these things, the first prints of bills have, like, handwriting all over them.
Yeah.
From last minute changes at a conference committee or something. So, you know, Congress is not sitting there perfecting their legislation. And then it used to be that they could pass, you know, sort of nonpartisan technical amendments that would fix certain parts of the legislation. Well, now that's, I mean, you saw that with Obamacare. They tried to do that in the next year, and everyone hates Obamacare. So now they're not going to pass that. And Congress passes so little legislation now, there's very little opportunity to go back and correct things.
Yeah.
And so now you got this situation where you got the Madison Cawthorns of the world who just want to go on TV and yell about stuff or raise money or whatever it is they're doing.
Right.
And you've got a Supreme Court saying, hey, unless your legislation says it in the right way, you can't implement it. And so you got this kind of thing where like Congress isn't getting better at writing legislation, right at the point where writing good legislation is even more important than ever. So I think that's going to leave a lot of regulatory agencies in the lurch, not knowing what to do. And we are going to have a ton of court fights over this. To be honest, I'm sort of a fan of forcing Congress to do its job better. And
is most needed. Right.
yeah, and I think that they should have to deal with the consequences. And I don't think they should get away with blaming the bureaucrats for their mistakes, you know? So I think this long term, it's going to be a good thing. But, you know, I do think that in the short term, it's going to create a lot of chaos and a lot of uncertainty.
Yeah, you've talked about that before.
And
yeah,
I'm not even sure. I haven't read anything good. I'm going to look for this. But I really want to find something on what like things are now in jeopardy based on the Chevron ruling. Because I think there are whole aspects of environmental regulation and other all across the board that are just their regulatory regimes based on foundation of sand because it was never in the legislation.
Precedent, not actual. Yeah.
Yeah, I mean,
can you think of anything? Does anything come to mind?
Yeah, I mean, I do think that there.
I'm thinking like off the top of my head, but
I'll actually probably write about it a little bit going forward. But I think the environmental is going to be a big one. And things like the Clean Air Act and Clean Water Act and this kind of things. I mean, we've been battling about these things for years. And I think that they're, you know, I'm not detailed enough on those right off the top of my head to say, oh, this is what it's going to be. But I think it's going to be a lot harder to extend, you know, like there was a whole fight under the Clean Water Act
for years
where they were defining what waterways were. And so like how deep into the waterway, you know, what kind of waterway constitutes a waterway? And like, as a result,
what qualifies as water?
Yeah. Well, it's like, can I regulate your pond on your farm?
Yeah.
Right.
Right.
Or do I have to like restrict it to the river 5 steps down? Right.
Yeah.
So that's a big deal. Cause like if it's the pond, you can regulate every agricultural app and every, you know, animal where you're raising hogs or
every CAFO.
Chickens or whatever, you know, so like you can get into large sections of the economy through that. And I'm going to think, hey, the Chevron defense probably helped extend it more toward the pond.
Well,
and now it's going to fall back.
More on that then.
A little bit more.
Yeah, I think we definitely need more on that, Alan.
So that's good and bad, right? Maybe more pollution, but maybe less regulatory burden.
Well, the final topic was the NFL kickoff rule.
So the NFL is the best, bar none. But they have royally screwed up this year. So there's the kickoff in the NFL game that starts the game. And after you score, you kick off to the other team. And so they've created this ridiculous rule where both teams have to line up and no one can move until the kickoff happens and the person receiving the kickoff gets the ball. So before it was like you kick off and everybody runs to go get the ball. And there's one or two guys down there.
And now they have to just stay there.
They have to stay.
Why?
And if the ball lands between the end zone and the 20-yard line, it goes, I can't remember now what it does because everyone's kicking into the end zone now. But if you go into the end zone, you go out to one place. And then if you go in between the 0 and 20, you go to another place. And like, it is the most awkward thing I've ever seen. And like every single time. So everyone's just frozen on the field for like a minute. Then this guy catches it, and every single one is just a touchback. So it's completely useless thing to do.
So why did they do it? I mean, I know nothing, right? But like, why in a nutshell?
So they were trying to force more returns. And so they wanted to give the guy catching it more of an opportunity to return back because you can't start running after him until he catches it, right? So most kickoffs were boring. But now they're really weird and boring because everybody's frozen on the field.
That's a great combo. It just sounds like a play subsidy to me. It's like now they need more.
Yeah, I mean, it's the saddest. I'm just hating it. I think it's a 1-year rule. It's going to be gone.
Yeah, maybe you could start talking about it at your son's football games. Like you could start,
All right. So everybody has to line up and no one can move except for the kicker and the person receiving it, or if you have two people, you can have two people down there. And no one can move until the ball hits the ground or the kickoff receiver catches the ball. One of those two things, right? And so everyone's frozen on the field, waiting to see what happens. And then if the ball goes into the end zone, you can either return it as the receiving team, or you go back to the 30-yard line. If the ball hits the landing zone, which is between the 1 and the 0 and the 20-yard line, and goes into the end zone, you get the possession at the 20. So you lose 10 yards if you don't return it from the landing zone. And any kick in the landing zone, like if you get it in that between 0 and 20, you have to return it, right? And then if you go out of bounds, it goes to the 40. Okay, so basically what they're trying to do, incentivize the kickers to not just put it in the end zone for a touchback, because I think last year you went to the 25-yard line. So they're saying, like, if you can get it between the 0 and the 20, they have to return it. But if it dribbles it in the end zone, it goes to the 20, and if you just kick it in the end zone, it goes to the 30. And so now they have this stupid thing where everybody's frozen, and they show this little zone. I don't know, like some 90% of the kicks just go into the end zone and no one does anything. And then there have been no great kickoff returns or anything like that. And the whole thing is stupid. They should just go. First of all, I think they should get rid of the kickoff. I think it's stupid. Just give the other team the ball on the 25 and forget this whole ritual.
But that's why you can call it football.
You still have to kick field goals and extra points,
right?
And have punts.
Okay.
And this isn't true for punts, right? It's just for kickoffs.
Sure.
So, or just make people like punt the ball or something. I don't know. Like that doesn't seem to be the biggest problem in the world. So I think it's totally stupid. It makes me sad that the NFL has done this. But I guarantee you that it'll just be a 1-year rule and be gone.
They're just trying it on for size, Alan.
Yeah. So Bill Belichick said, the guy's a god, right?
Right.
He thinks it's stupid because he thinks the 30-yard line possession isn't worth the risk of giving up a long return. So basically what he's saying is like, why would you kick it between the 0 and the 20? Now you got a shot that you're going to tackle the guy at the 15. But is that 15 yards worth the chance that guy could take it all the way down or get a huge return or get a touchdown?
Right.
Because remember, you can't run at him. Like before, you could have fast people that got down to him before he caught it. And then as a result, you could have like a pretty good chance that he's not going to get through. But now that you have to stick and you can't run until he catches, there's a good chance he might get past you. So what you're seeing is every team's just kicking it right into the end zone and just giving it or they're trying to kick it at the 5-yard line and have it roll in and go to the 20. And that's what every game has been like that so far. It's ridiculous.
So it sounds like they were making the change to make it more exciting, but in fact, the result has been the opposite.
Right. It's both less exciting and looks really stupid.
Yeah. So what do we do now?
Because everyone's like frozen on the field. It's like the witch from the Book of Narnia turned everybody into stone and no one can move.
Yeah. One of my favorites.
So I'm hoping that the greatest sports franchise in the world on TV comes to its senses next year and gets rid of this rule. It was far better last year, or just get rid of the kickoff altogether.
Well, it's going to have to.
If you come up with a rule, maybe ask Bill Belichick about how it's going to get gamed before you put it into place.
World domination.
So we'll see, but I'm with Bill. I'm skeptical.
Well, remains to be seen, but I think this is a good start. Getting the conversation out there.
That's right. That's what we're all. The new rules. But part of the podcast is just going to be the new rules of football every year. We're going to go.
Right. That's what we're doing here.
Yeah. Well, the other thing about football rules is they're insane. They are so prescriptive.
Right. I think there should also be a mini rant each time, too. Because
the game's so weird. Like if you actually read the entire kickoff regulation, it's like a lot of stuff.
Right.
No wonder the refs can't ref. It's so complicated. You have to spend all your day studying the rule book.
Yeah. And if you actually didn't grow up watching football, like, say, my husband, for example, who is from another country, and when he moved to the States, like, he liked football. I mean, and he's not a dumb guy, but trying to figure out the rules, it took him like 15 years.
Yeah, no, you have to do like a Coursera course before you watch to really understand.
I still don't get him, but, he tried at least.
But I mean, I have to say, there's nothing better than when somebody hikes up like a 30-yard beautiful pass for a touchdown, there's something about that no other sport can capture.
I get, yeah.
And I'm going to watch my son's football game tonight. So,
yeah,
it's in the blood.
I know. So you hope there's blood?
No, it's in the blood.
Oh, in the blood.
No, I hope there's no blood.
I was like, what? No, you didn't.
Well, he's a younger guy on varsity, so he's not getting much playing time. So if it's blood, it won't be his.
Yeah. So there'll be no blood. Hopefully.
He comes out with clean pants every time. So
I hope so.
Cool. All right. This has been fun, Tonya. What do you think?
Yeah, it has been fun.
Yeah.
So we'll be back here next week then.
Yeah.
Okay.
And hopefully we'll resolve our technical issues. But
yes, we'll resolve technical issues and solve all the problems of the world.
Cool.
All right.
You've been listening to The New Rules with Alan Pentz. For more insights on mastering the new game, follow at @Pentz, that's APENTZ, on X, and make sure to subscribe to the podcast so you don't miss a single episode. Thanks for tuning in, and remember, in today's world, you don't follow the rules, you write them.